Welcome to the Explainer. Today we're actually strapping in for what I can only describe as a true financial detective story. We're going to be looking at the bizarre, the contradictory, and frankly, the fascinating numbers behind a company called Cytokinetics. If you love a good mystery where the surface level numbers just literally do not add up, well, you're absolutely in the right place. So let's look at the very first clue. $7.838 billion. Yep, that is the current market capitalization of Cytokinetics. The market is valuing this company at nearly $8 billion. By any standard metric, that's a massive valuation, and it signals some huge confidence from Wall Street. But hold on a second, wait until you see the very next piece of evidence. Negative $784 million. That's their trailing 12-month net income. So let me get this straight. While the market values them at nearly $8 billion, they've actually lost close to $800 million over the past year alone. Talk about some serious financial whiplash, right? Section 1. The $8 billion paradox. Okay, let's dive into this and see exactly how those two numbers can possibly coexist. What is truly staggering here is the sheer contrast in their margins. I mean, on one hand, we're looking at a flawless gross profit margin of 100%. Boom, perfect. But then on the other hand, their net profit margin is an absolutely unbelievable negative 1,771%. No way, right? Basically, this tells us that while the core cost of whatever limited product they might be putting out is negligible, the sheer weight of their operating expenses, their research, their overhead, it's just completely obliterating their bottom line. It's a paradox of epic proportions. Moving on to Section 2, History of Returns, an explosive ride. Let's see why investors tolerate these kinds of extreme losses. Because their year-over-year returns, they're a complete roller coaster. Just look at this. Back in 2021, the stock shot up by over 119%. Just incredible gains. But fast forward to 2024, and it cratered, dropping nearly 44%. Then, literally just a year later, in 2025, it bounces right back up by 35%. This perfectly captures the intense volatility we're dealing with. This isn't some sleepy dividend stock you buy and forget about. It is a wild ride, and traders are clearly placing bets on these massive swings. But hey, here is the real kicker. Despite those wild yearly swings and those massive net income losses we just talked about, long-term investors have actually been handsomely rewarded. Look at the 3-year return, it's over 69%. The 5-year return, over 151%. And the 10-year cumulative return stands at a staggering 654%. It's crazy. If you somehow manage to hold on to this thing through all the chaos, your patience paid off exponentially. But as we pull back the curtain even further, the mystery just deepens. Their trailing 12-month revenue is only $88.039 million. Just think about that for a second. An $8 billion company generating less than $90 million in revenue? The math here is highly, highly unusual. Which brings us to Section 3, Red Flags and Losses. Let's look at this massive cash bleed. The underlying metrics here detail a really severe and ongoing cash burn that would normally make traditional analysts panic. As we already noted, the net income sits at negative $784.9 million. But look right beneath that. Free cash flow? That's negative $534.8 million. And their free cash flow yield is at negative 6.82%. Now, just speaking neutrally here, these numbers indicate a company that is burning through cash at an astonishing rate, literally just to keep the lights on and the research going. And then we hit this number, negative 119. That's their return on equity, or ROE. Now, as you probably know, a traditional, healthy company boasts a positive ROE, showing us how effectively they use shareholder money to actually generate a profit. So a negative 119, that emphatically underscores the complete lack of traditional profitability here. Shareholders are essentially financing a massive, highly expensive operation that just isn't turning a dime of profit right now. So how is the market pricing this? Section 4, Valuation Multiples, Pricing the Risk. To really understand this, we need to look at the price-to-sales, or PS ratio. Just as a quick refresher, this classic valuation metric tells us exactly how much investors are willing to pay for every single dollar of sales. For context, a normal, mature company might trade at a PS ratio of, say, 2 or maybe 3. Well, Cytokinetics has a PS ratio of 89.03. That is historically extreme. I mean, investors are paying $89 for every $1 of revenue this company brings in today. It shows an absolutely unbelievable level of premium being placed not on what the company is doing right now, but on what the market believes this company is going to do in the future. Next up is the EV to sales ratio. This metric goes a step further by comparing a company's total enterprise value, which remember means the market cap plus its debt minus its cash, to its overall sales. It's often considered a slightly more comprehensive look at what a company is truly worth relative to its sales. And this brilliantly illustrates the market premium. Their EV to sales ratio sits at an incredible 91.68. Whether you look at it through the lens of pure market cap or total enterprise value, the conclusion is the exact same. The market is paying a massive, astronomical premium for this company's top-line revenue. Section 5. Surviving cash burn. Strong liquidity. How does a company bleeding this much cash actually stay alive? Well, take a look at this juxtaposition. On one hand, we have that terrible profitability we just discussed, deeply negative returns on capital and equity. But contrasted against that is a silver lining of surprisingly strong short-term liquidity. Both their current ratio and quick ratio sit at a very healthy 4.53. So what does that actually mean for the company's survival? Well, a current and quick ratio of 4.53 means that for every single dollar of short-term liability they owe, they have $4.53 in highly liquid assets ready to cover it. To put it in plain English, they've got a very healthy runway. They might be burning a ton of cash, sure, but right now they have plenty of cash on hand to keep feeding the fire. They are not going bankrupt tomorrow, for sure. All right, let's bring it all together. Section 6, high-stakes gamble, the future promise. Let's quickly recap the evidence we found. First, there is explosive recent growth somewhere under the hood. Their trailing 12-month revenue compound annual growth rate is up an astonishing 376.56%. Yet that sits right next to absolutely zero earnings per share growth. Nothing. We have staggering sky-high valuation multiples, like a price-to-sales ratio of roughly 89. And despite the total lack of current profits, we've seen immense historical market returns of over 650% in the last decade. It's really a stock entirely decoupled from its present fundamentals, trading purely on massive future expectations. Which leaves us with this final pivotal question. Is the promise of future revenue actually worth an $8 billion price tag today? Well, Wall Street certainly seems to think so, placing a massive bet on whatever Cytokinetics is building behind closed doors. But what do you think? Thank you so much for joining me on this explainer. Until next time, keep questioning the numbers.